Welcome to the Budget Series with BCL India. I'm Sandeep and I'm joined here with Mr. Varun Darira. Varun is a director at Centrum India and he works with high net worth individuals and handles investments worth more than $1 million. He's based out of Bangalore and he's been here for the last 14 years. Varun, if you're ready, the first question I'd like to ask you is just to get your reaction to the budget. What did you think about it?
I think it's a very bold budget, and after a very long time, we have seen the finance minister come out and uh, taken some bold steps in terms of not worrying too much about physical deficit. They have gone ahead with keeping the growth in mind for the country. And post COVID, I think growth numbers have been very strong. Economic indicators have been very strong across various sectors, barring maybe travel and tourism. Obviously, has been hit the maximum because of COVID. Barring two, three sectors, I think broadly all sectors have bounced back very well. So I think it's a very positive budget. I think there's an analogy where a fund manager actually wrote a very interesting article stating that there's a similarity between a movie of Hema Malini and characters of Hema Malini in the movie Geeta and Sita, where Geeta was obviously very shy and introvert and not so easily mixing with people and stuff. So I think his analogy was India was previously like that, and now we have Sita in place, and we have taken some very bold steps to get growth back on track. Sita was more extrovert and more bold as a person, and we have taken some bold steps. And I think we are the fifth largest economy in the world, and these were some steps which we needed to take to as the mission of the current government, or they want to make it a $5 trillion economy, and they have taken those steps. Now it's up to the team to execute. We have to wait for the execution this whole coming few months.
Right. The market seemed to react really well to the budget. I think the surge was by almost 3,000 points over the last couple of days. What is your view on that? Why do you think the markets have reacted so positively?
I think before the budget was announced, there was a lot of noise that COVID cess could be introduced, wealth tax could be introduced. People didn't know what was coming because they knew that the government was running a physical. Are they going to collect money by taxing the super rich, or what are they going to do? People were a bit confused. So before the budget, market corrected a bit, and once the budget was announced, that they saw that the government has not tweaked with any of the personal taxation of people, and they've kept it intact. So markets obviously reacted very positively to that. That is one aspect. And the second aspect was obviously before the budget announcement, post the lockdown, we had the most severest lockdown worldwide. We had a 67-day lockdown. So post that, if you see, economy slowly bounced back month on month. I think Uday Kotak put it very well when lockdown had suddenly opened up, and they said that let's look at data month on month basis. And if you see the data post June, every month you would have seen indicators, economic indicators improving. And I think last quarter and the quarter before that, last quarter is an example where we saw very strong economic indicators, very strong market commentary by the Nifty 50 companies. If you break down the 5-6 top sectors, right from Bajaj Auto to Hero to all the automobile makers to the FMCG companies to cement companies, everyone has come out with very strong market commentary and strong guidance. So that has obviously impacted markets rallied. And post that, now this quarter results are, I mean, we have already done with majority of them, some more coming up soon. So all this put together, there's a lot of good news around. And obviously with this budget coming at the time where there was more sentiment driven rally, so sentiment is also driven, and obviously there is a lot of positives also to take away. Obviously the only dampener is valuation is expensive. We are slightly expensive, but if earnings is there this year, if we have strong earnings, strong recovery, as per projection also we might grow at 11% this coming year. So that is also a strong indicator. So markets have kind of taken that into the stride.
Right. As you mentioned, the country's bound.
Yeah.
Yeah. As you mentioned, the country's bounced back quite well after the pandemic and after the lockdown. across most sectors except for tourism. Why do you think that is? How do you think it is that we've managed? Because a lot of other countries are still struggling in terms of coming out of the pandemic and in terms of
Honestly, I'm not a expert on COVID as such. Why we have not been, I mean, less impacted vis-a-vis Europe or US. I don't know if anybody has an answer or any data to prove why this is so. But I think the situation is such that our numbers are active cases are hardly anything to the rest of the world. Looking at the population we are in, and the good part is we have already had the vaccine rollout, and hopefully touchwood vaccine rollout is it's successful, and slowly other vaccine manufacturers, other players who are under research, Johnson and Johnson's results are awaited. All these factors, I hope they play out well, but I don't know why we have why our numbers are less. So I don't have any data to prove it. I don't know if maybe a medical professional or somebody in the health who understands these things better than me, they could explain this. But I don't know. I honestly don't have an answer for this.
fair enough. Moving on to equities and bonds, we wanted to get your view on what you think the future holds for these.
I think interestingly, see, last year was a very interesting year. In the month of March, when markets corrected and we hit 26,000 index, so people thought that the world would actually come to an end. We don't know what Corona would open up. It would take 4 quarters, 3 quarters, 1 year of the whole economy to restart. There were multiple things. So at that point of time, many people panicked, pulled out of equities, sat on fixed income for some time. But by the time they wanted to enter markets, markets already bounced back to 36, 38. It was too swift a rally for anybody to catch. There could be a series of factors. Global liquidity also was high. But if you see last year alone, if you see equities did well, bonds did well, gold did well, Bitcoin did well, only real estate didn't do well. So only that was the only asset class which didn't perform. So this year, what we feel is obviously the kind of numbers everyone has. I mean, no quarterly results and so much positivity, so much sentiment. Everyone is looking to do something. That positive energy vibes are very positive all round. So uh, I think on the fixed income side, FDs are decent options. Fixed income mutual funds, where you have AAA focus, that could be a good option too. And if somebody wants a slightly more like a return which is coming out to them annually or half yearly, annually they could look at bonds like maybe a state bank or any of these varieties perpetual bonds, good institutions, I mean government backed institutions, if they want to play it, it's extremely safe. Equities, obviously, I think domestic institutions have not really participated. They have been net sellers. They've not participated the way FIs have participated. So you could see a lot of retail money coming in. You could see a lot of participation. So I think it will be, I mean, I don't know how it will pan out in terms of a return perspective, because there's so much of positivity. From here, it could easily go up another 5, 7% or even more. But overall, things are very positive. It's difficult to put the exact number, but I think if you stay in for the long term, 3 to 3 years plus in a good quality fund, good quality PMS, or good quality stocks, good blue chip stocks, plus a little bit of mid cap exposure through funds where fund manager has good experience of good 10, 15 years plus managing funds and has a track record, or a good fund house who has a good ideology of managing funds. It could be PMS or it could be funds, whatever, PMS. So you could participate in multiple ways. But on a long term basis, equity will always outperform fixed income. But people who are fixed income oriented, I think options are very limited because returns have fallen quite a bit from 24 months from here, 24 months back to now. I think returns have fallen quite a bit. A good quality, like a State Bank of India FD will yield you about 5%, 5.1, or a HDFC also would be very similar in nature. So options are limited in the fixed income space. But if somebody wants to maneuver that, there are options: buying bonds, buying corporate fixed deposits like maybe an LIC housing finance, or some other options in the bond space. So it's an interesting year. Let's hope and see. I think 2020 we thought that people would not make money, and today everything is positive, that we feel like we will make money, but we don't know. Markets always surprise us on the short term. But if you do fundamentally the right things of buying good quality stocks, good quality funds, or PMS, or any other way of participating in equity, because there are two ways only of creating wealth. One is obviously you build your own equity through building your own business, and the second way to actually make that equity kind of return is to invest in good quality companies, uh, either through by yourself if you have the knowledge and the patience and the time to do it, then buying good quality equity stocks, or do it through a professionally managed mutual fund or good quality PMS. Options are plenty in the market.
Yeah, fair enough. So moving on to unit-linked insurance plans. Yes, in the budget, it was announced that ULIPs with an annual premium of more than 2.5 lakhs will no longer be tax-free. So considering this, do you still view ULIPs as a good investment?
See, I look at ULIPs slightly differently. Uh, Obviously, now it's a level playing field for a ULIP and equity-based instrument. So now earlier equities were taxed at, still taxed at 10%, where ULIP was not taxed at long-term capital gain at 10%. So now obviously it's going to be taxed. So now it will be a level playing field for ULIP. And now, see, ULIP, there are some advantages and disadvantages. Obviously, you have to stay the course to make money. But ULIP as a product, so what it used to be and what it is today, I think it's become more attractive for clients to look at in the recent past. But given the current atmosphere we are in, I think choosing a good quality equity mutual fund or a PMS could be a better option, only because you have an option of exiting and realigning portfolios. But ULIP also has an option where you can switch from debt to equity, equity debt within the fund. So there is benefits on both sides, but still I feel mutual funds or good quality PMS would beat a ULIP in the long end of the curve. Uh, People bought it because of the tax advantage. Now that is not there. So for smaller investors, yes, it could still make sense because you could keep switching from equity to debt and vice versa. But on a larger investor, I think doing good quality funds or something gives them more flexibility.
Right. Fair enough. Okay. Yeah, I think that's it. I think we've got everything covered. Just like to thank you for your time and for your insights. We really appreciate it. And
Thank you,
yeah, it was good
Sandeep.
connecting with you.
Thank you for BCL India. I mean, you guys have always helped me and my clients, and I would obviously strongly recommend to work with you all, and you have always been very helpful anytime.
Great. Thank you.
Thank you. Thank you. Thank you.